and welcome to Macros with Mythili, our weekly program where we take a hard look at all the major macroeconomic developments in India and overseas. Well, one development that's slowly assuming perhaps even more importance than the interest rate hike by the US Federal Reserve is a slowdown in China. On Saturday, 27 June, the People's Bank of China cut its benchmark lending rate for the fourth time in a row since November 2014. The reduction to a record low came after the Shanghai composite index fell 7.4% the previous Friday, following a 14% decline the previous week, and marks a stunning reversal of an amazing bull run, 120% in the year to date. Meanwhile, economic growth is also expected to slow down to 7% in 2015, the slowest since 1990. What does all this mean for China, for India and for the world at large? To discuss all this and more, we have with us three experts on everything Chinese. We have Alka Acharya, Director and Senior Fellow of the Institute of Chinese Studies, Delhi, Ajit Ranade, Chief Economist at the Aditya Birla Group, and TCA Ranganathan, former Chairman and MD, Exim Bank, who incidentally also opened State Bank of India's first branch in China in Shanghai in 2005. Welcome to the show. Alka, if I may start with you as somebody who keeps a close watch on everything that's happening in China. How real is this slowdown? Because we've had this discussion, a very similar discussion almost a year ago, and then again China bounced out back, as it were. So are these stories about the Chinese slowdown real? Are they a figment of imagination? Is it just the Indian wish to see China's growth slow down?
No, I think the slowdown is real. I mean, if you talk purely in terms of numbers, yes, the Chinese growth rate is going to come down from those dizzying double-digit figures to single-digit. Now, this is something that the Chinese government is doing on its own. So let me quickly make 3 points about this slowdown and really what is the framework within which we need to address it. The first, and I'll try to give you a flavor of the discussions among the Chinese economists themselves about this slowdown, or as it has been dubbed, the new normal. In fact, the Chinese debates are all about the new normal, because that is what the President Xi Jinping last May had said in a speech, that China was entering a phase of a new normal growth rate. Now, economists, both the establishment kind as well as those who are academics and scholars in the universities, they make 3 points, okay, and I'm sort of summarizing. First is, what is so extraordinary about this, and to say that this is going to be something that the world will have to really deal with very seriously. The world dealt with China going at 10% a year. There was nothing normal about that, they say, because it actually overstimulated and overheated the economy, and there's nothing normal. So in other words, we don't have to see this in terms of normal or new normal, but something that is happening inevitably once a country reaches a certain GDP level and certain per capita GDP. So China is already a 10 trillion economy. GDP per capita is almost 7,000, and they point to the fact that if you look at Singapore or Hong Kong or Taiwan, Korea, all of them at 7,000 GDP per capita slowed down to 6.3, 6.3, 6.2. So they say that China is also going to come down to single digit, and there's nothing either unexpected or phenomenal about it. The second set of issues is that why has this slowdown occurred, or in other words, is it something that the government has deliberately done? Yes, if you look at the 12th plan, targets were deliberately brought down there, and that was a signal that was being sent by the central government to the provincial governments and the local governments. Let's go for quality now, not quantity. And finally, why this slowdown is necessary is because change in the factor markets, particularly labor markets, but manufacturing continues to be at a high. China is still the top export partner of nearly 40 countries, so we are not going to see something disastrous happen soon in the near run. They are going to focus on innovation, innovation-led economy, and finally, they want to control this excessive dependence on energy, unlimited energy supplies on the one hand, and the housing and investment on the other, as means of, because they've been creating asset bubbles. So that would be more domestically oriented, and it would, the idea is that it should now target a more equitable growth and results for the domestic consumers.
Ranga, you make a very similar point outside. So is this entire Indian, what we call Schadenfreude or whatever it is about China, we are finally overtaking the Chinese rate of growth, etc. Is it all quite bizarre? Because actually China is now a much larger economy and growth is bound to plateau, as Alka says.
No, not only is it a much larger economy, and I concur with what Alka is saying, but also China is undergoing a remarkable internal transformation towards a higher quality range. E-retailing, they have exceeded US targets now, they have crossed the US levels and it's growing very fast. Use of internet, cloud computing and other technology services in the corporate sector is tremendously rapid. A number of high technology items are being what you call focused upon out there. The sheer number game which we talk about, when I went there, the Chinese economy was about 2.3 trillion and they had a 12% rate of growth. So the annual growth in GDP was about 200 billion. Now it's 11 trillion or a 10.5 trillion economy. 7% on that is 700 billion growth. 700 billion growth.
So it's a different order altogether.
It's altogether different order. On a labor force which is not growing very fast. It is likely to plateau off by 2019 or 2020 and then start falling. The number of fresh jobs which are being demanded is far more than the supply which is there, and the wage increases are phenomenal. When I was there in 2005, the average labor cost was about 1100 to 1200 RMB for a green person in a factory, completely unskilled. Today it's excess of 3000 RMB. RMB to a dollar then was 8 point something, now it is 6 point something. Rupee equivalent was 5.5 when I was there, now it's 10. So that means a green person with no fresh thing is costing 30,000 plus rupees in China. That is the transformation which is taking place. So the lower end is going off and the creative destruction, those jobs are going. Higher end is going up. So that and the net process is a lower rate of growth, which is a summated figure.
Okay, so let me ask Ajit, because Ajit, as a member of the India-China CII Council, how has this impacted Indian corporates functioning in China? Are we comparing apples and oranges when you look at the Indian and Chinese rate of growth and just draw conclusions from them?
Well, first of all, Mythili, you know that India-China trade has been growing tremendously, although last couple of years it slowed down. So the trade relationship was very vigorous. It was CAGR of something like 20-25% per year for almost 7-8 years. But compared to that, the investment relationship is not as strong, in the sense that if you look at Indian investment into China or reciprocally Chinese investment into India is not even perhaps 1% of the value of the trade. So if you look at it from that perspective, operating in China, of course, is very different. One thing that we are seeing is that because of the slowdown or because of pressure on margins, because of pressure of slowing demand from the export markets, the kind of cost economics in China is very opaque or sometimes misleading, in the sense that with a combination of perhaps below market cost of capital, of labor, of electricity, of land and other resources, sometimes the Chinese export, the price of exports can be lower in their destination markets than their competitors. So much so that there are examples where despite paying anti-dumping duties, the landed cost of Chinese goods is still lower than the local product. So that is, I think, a consequence of the fact that with slowdown and perhaps as Ranganathan was saying, that there's a transformation, there's a desire to move away from export dependence, to move away from investment dependence and more on consumption. The bottom line is still that the Chinese economy has only 33-34% of GDP as consumption spending. So there is still a large dependence on investments and exports. And to that extent, if they want to keep the export market share intact, there is this phenomenon of underpricing. So that is what we are seeing as a consequence of the slowdown, is that there is a bigger, shall I call it, pressure on the Chinese manufacturers to export at lower costs.
I'm afraid on that note, we'll have to slip in a very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the slowdown in the Chinese economy. How real is it, and what are the implications for India and the world economy? Ajit, this time I may start with you. You said China is trying to export its way again out of trouble. But the general belief really is that the export-led model of growth, the mercantilist model of growth, is really dead, and China cannot go down that path again. How valid is that argument?
No, it is valid, no doubt. But you can't transform overnight. This is an economy which has demonstrated fantastic growth rates, fantastic job creation over a period of almost 3 decades. And of course, it's been an export-led growth and export-led success story. This is not sustainable, and therefore they need to transform away. As I said, they need to move away. But this is not going to happen overnight. If you want to increase the domestic component, that is consumption spending, you need to increase consumer purchasing power, which means that wages and incomes have to rise. One kind of remarkable feature of the Chinese growth story was that while investment was growing at 30-40% per year and GDP was growing at 8 or 10 or 11% per year, real wages adjusted for inflation were not going that fast. In fact, employment was growing but not wages. As a consequence, consumer purchasing power was not keeping pace, and therefore consumption spending as a part of GDP came down from 56% to 33%. By comparison, in India, the share of consumption spending is above 60-65%. So for China to now turn that around, it's like making a U-turn of a big aircraft carrier. That will take time, and therefore this is a transition period where they can't let go. Obviously, they can't let go of the export markets, and whatever it takes. Now remember, we are living in a slowdown world. We are living in a world where commodity prices have sharply fallen. Many of China's exports tend to be commodity intensive. If there's one, in the BRIC, the BRIC economies, both B and R, Brazil and Russia, are suffering because of slowdown in commodity markets. In fact, their growth rates are negative this year. In that context, China, of course, is going to struggle to keep its export share. But on the other hand, as Ranganathan said, the focus on innovation, the focus on new technologies, internet, cloud computing, the focus on higher value added, the focus on, all that stuff is going to play, climbing the quality ladder. I think that is going in parallel. So we will see that transition, but it won't be as fast as people imagine. So therefore, the export dependence will continue for some time.
Ranga, Ajit seemed to have a slightly different perspective from you. He feels the export dependence will continue, wage rates haven't increased so as dramatically as you said. So is the Chinese economy becoming more and more like the West or not? Particularly if you look at the asset bubble in the stock market, that seems to be a very developed market kind of feature.
If you look at the export dependence, the trade to GDP ratio when I was there in 2005 was 65%. Today is 45%. India trade to GDP is 45%. They have come down to our level. Second is the concept of exporting below cost. I used to hear this before I went, and I went around number of plants across various centers. What they are taking advantages of economies of scale and marginal cost pricing. The concept they operate on is of turnover, and if the marginal costs are covered and something goes towards the fixed cost, it is better than not having the production. In India also, a number of companies which went in for large-scale operations showed that behavior. There's nothing irrational about it. As far as other aspects are concerned, they will be they have been experiencing very steep wage increases. It is not that they are underpriced. It is not that there is cheap labor there. And there is very steep shortage of labor, especially in the lower end. A number of lower end products are dying off, and deliberately they are being allowed to die off.
So is that export-led model of growth dead? Can India replicate it at all?
You see, the world as a whole, what Dr. Ranade said also, it is not a conducive place for export-led growth for anyone. You have to have self-sustained growth. And China has been rebalancing, and they have been attempting this rebalancing not in the last 2-3 years, but right from 2005, 2006, when President Hu Jintao had said that we will go towards a harmonious society and innovative society. They have been trying to rebalance their economy away from export-led growth toward domestic this thing for the last 8-9 years. It's not something new which has happened. And they will continue doing that. India, we have a huge amount of potential Indian demand, which is manifested demand for products and
so we don't need to look out.
which we are importing,
Okay.
which we can always have domestic manufacturing taking place. There is enough revealed demand to permit manufacturing in India to meet Indian. Costing this thing comes from technology and comes from scale economies. You cannot fight scale economies and you cannot fight technology. So this is a challenge which Indian corporates will have to overcome, because in a market where excess capacities are being created and demand is not growing, and then world is completely opened after the GATT agreements and all that, there's fair amount of openness. You have to compete in that world.
Alka, both you and Ranga both talked about how this is a deliberate slowing down of the Chinese economy. If that is so, then why is the People's Bank of China deliberately trying to stimulate the economy? Doesn't the action seem contrary to what the leadership wants?
No, I think those are two different things. One is that you are focusing on quality, and therefore the speed of production or the rate of production is sought to be brought down to more manageable levels. The other thing is that, I mean, just get back to that, if we look at it, this whole question in the framework of the transition process that is going on, we are looking at three different kinds of transition process. One is this transition in the economic growth rate. Second is that we are looking at a transition adjustment of the levers of the economy. What are going to be the new drivers of economic growth in China if we move away from the heavy investment oriented kind of growth and towards more innovation based? And the third is that the Chinese economy is still trying to go through the process of digesting the stimulus package that had been unveiled in 2008 in the wake of the global financial crisis. 4 trillion economic stimulus, a lot of local governments and provincial level governments got into huge debt. So they are staring at that. Now, there are two things. One is the slowdown itself, what it means for the world, what it means for India. The other is the internal Chinese economy dynamics, the problems. You know, what we are looking at, and I would say that, look, the question of export-led or dependence on exports continuing unquestionably, and yet you see that the whole pattern of exports, production is changing because of the globalization of the economy. The Chinese are moving industries out. So you have capital coming from somewhere, technology from somewhere, labor from somewhere. So the whole pattern, the integration of the economy.
So the Chinese government is trying to move out from an investment-led economy into a consumption-led economy.
Yes, and the other side of the coin is that they are now going to be looking at infrastructure. And that is where, you know, this whole high-speed rails, connectivity, this whole one belt, one road, where they are going to connect Asia, and that's where the money will be going.
I'll come back to that question. Afraid on that note, we have to slip into a very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the Chinese slowdown and its implications for India, particularly in the light of the stock market correction that we've seen in recent weeks. Ajit, before the break, we were talking about how China has consciously kind of deliberately slowed down its economic rate of growth, etc. And there is a general view that the capital that is flowing out of Chinese stock markets will now automatically come to India. Is that a very naive presumption?
Yeah, I think, Mythili, it's because the scale is so different. The daily turnover in the Chinese stock market is probably 20 or 30 or 100 times more than the Indian stock market. So really, there is no comparison. And despite the recent 22% fall in the Shanghai index, it's still 50% above last year. You know, so this is just a correction, like you said. It's not a real. It's not a bubble crash. This was, in fact, if anything, it was like a belated run-up, because if you look at the last 10-year performance of the stock market in China, it was stagnant for a long time, not in parallel, not moving in parallel to the growth of the economy, and therefore this was kind of a catch-up, and therefore this 100% increase was simply it went up too fast, it was overheated, and there's a correction. But some of it may come to India. There's no doubt about that. But the bigger worry for India is the flow that will start uphill going back to the US after the QE stuff begins. That is, you know, the rate hike in the US begins. That's a bigger worry than the turmoil caused by money either going in or out of China to India's stock market.
Ranga, there has also been talk of the yuan being included in the part of the SDR, and China is working very hard to internationalize its currency. How successful is it likely to be in those areas?
See, the attempt to internationalize the RMB has been on for last 5 years, and it is succeeding. Amount of trade which is being settled in RMB now has crossed 15%. It used to be almost negligible, it went up to 5%. It was stagnant at 5-7%. Now it's crossed that level. And a large number of centers are opening yuan-based accounting. Even London was the latest this thing, and they have announced that they'll have yuan-based accounts, and you can. So the drive is on. The fact remains, China is the biggest trading partner for majority of countries which are relevant in trade. 40 out of those 40 are the most important trading companies. All of Europe, China is one of the biggest partners. For US, China is the biggest partner. For us, China is the biggest car. So for everyone, it's important. And RMB settlement is possible, but it will not very easily happen right now because the swap markets and the derivative markets on RMB are not there. It will take time. So I don't expect it to suddenly overnight, and I don't think it will be relevant for the trade patterns on which currency you denominate your trade in, because all exporters work ultimately with their home pricing and home profitability, and currency settlement is based on convenience, based on cost of transaction. So if the cost of transaction in RMB comes down versus a dollar costing, and there are a lot of other issues involved in invoicing, in trade financing, so those things are not going to get sorted out fast. But yes, China will be going towards, and RMB and the yuan will be a part of these things sooner rather than later.
Alka, net as far as India is concerned, does a slowdown in China, help India or not? Because after all, India and China compete for raw materials all over the world. So if China slows down, there will be less demand and prices should come down. So net, will we benefit or will we not benefit so much?
See, these things are rather difficult to calculate. I don't think that we are going to see anytime soon a drastic reduction in China's demand for raw material. Energy, yes, I mean, but that again we see that the energy is an entirely different ball game, and the way they were diversifying their sources of energy and so on. So I think we will need to see a bit more about China's energy policies before. But in terms of other raw materials, I do not see a quick slowdown.
Because the scale is still very large.
The scale is still very large.
Okay.
And the prices of international commodities, I don't think go down very drastically just because one country, even though it is a major player, reduces the amount it buys. So I won't look at that dimension, that is to say China's slowing of demand for raw materials, as one factor for which would be of advantage to India.
And does the slowdown change the role of China in geopolitics at all?
No, again, you see, there has been some debate whether this slowing down in growth rate means that therefore China's ability to cross the United States and become #1 would be further delayed. Like, for instance, some Western economists have started to argue that this is the end of the road as far as China is concerned in terms of overtaking the US by 2020 or 2030. They're taking it back further to 2050. Now, I am not so sanguine about the fact that this slowdown means that China is going to come to a grinding halt, because what we are seeing is the adjustment process that will inevitably take some time. But on the other hand, as has come out in the debate, the process of restructuring and the process of literally changing gear and focusing more in terms of how do you see. For instance, I was trying to make this point earlier, which was that the Chinese are also equally concerned about the internal dynamics. The growth rate has not been adequately evenly distributed. So they are also looking at domestic issues, plus this stress on innovation, which is going to actually then take the entire process into a different level. So I don't see this coming to a grinding halt anytime soon.
Okay, one last word from you, Ajit, before we wrap up this program. How does corporate India look at the slowdown in one word, positively or negatively?
I think China represents a huge opportunity, Mythili. If indeed it's going to be a big consumer market, if it's going to be like a 6 trillion consumer market, we cannot afford to ignore it. Secondly, we must crack open the market for IT services, for pharma, for tourism. The Chinese are the biggest tourists in the world, 100 million outbound tourists. Not even 500,000 come to India. And fourthly, entertainment services. So our exports to China must at least double or triple in the next few years, and that should be the focus of India's trade relationship. And of course, you know, this is a very dynamic and growing relationship. So I think from India's corporate perspective, this slowdown is not so much of a worry because it's just a number. It's going to go down from 7 to 6.9%. The number will come out on July 15th. But really, India must remain focused on tapping this large Chinese domestic consumer market.
Absolutely. So regardless of whether China is growing at 10% or 7% or 6.9%, as Ajit seems to suggest, it offers a huge opportunity for India, and that's where we should focus on. Thank you so much, Ajit, Alka, as well as Ranga, for being here with me and sharing your views. Thank you also for watching, but we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.